The math of freedom, how much you really need to live off dividends. Most people spend their entire lives working for money. They trade their time, their health, and their sanity for a paycheck that barely covers the rising cost of living. It is a cycle. A trap. But there is a different game. A game where your money works for you. It doesn't sleep. It doesn't take vacations. It doesn't complain. It is called dividend investing. Today, we are going to calculate the exact number you need to escape the 9-to-5. I am going to show you the math that the wealthy use to keep their wealth growing forever. If you have ever wondered how much you need to never work again, stay tuned. The answer might be smaller than you think. Before we do the math, let us clear the air. Many people think the path to wealth is just saving. They stuff their money into high-yield savings accounts or keep it in cash. They feel safe. But inflation is a silent thief. If your money is growing at 2% in a bank, but inflation is at 3.5%, you are losing purchasing power every single day. You are literally getting poorer while you save. Saving is for losers. Investing is for winners. To truly be free, your capital must be deployed into assets that provide both cash flow and appreciation. That is where dividends come in. When you buy a slice of a high-quality company, you are buying a revenue stream. You are becoming a silent business partner in the largest, most stable corporations on the planet. Why dividends? Growth stocks are exciting. They can double in a year, or they can cut in half in a month. But they provide zero cash flow. A dividend stock, however, keeps paying you even when the market is red. When you live off dividends, you are not forced to sell your assets during a market downturn. Your paycheck from the companies you own continues to arrive, deposit after deposit, like clockwork. That is true psychological freedom. That is the wealthy mindset. Let us look at the 4% rule. Financial planners say if you have $1 million and take 4% out, you are safe. But that rule assumes you sell your stocks. What if you want to keep the shares forever? That is where the dividend yield method wins. If you build a portfolio with a 3.5% yield, you do not need to sell the shares. You keep the asset. You just spend the rent it pays you. Let us break it down by levels. Level 1. The gas money stage. At $10,000 invested, you get $300 a year. It pays your Netflix, Spotify, or internet bill. You have successfully outsourced your first monthly bill. Level 2. The insurance stage. At $100,000, you make $3,000 a year. This covers your car insurance, phone plan, and gym membership. You are now covering the hidden costs of living. Level 3. The basic needs stage. At $300,000, you are pulling in over $10,000 a year. This covers your groceries and utilities. You are now partially free. Level 4. The freedom stage. At $600,000, you make $21,000 a year. You could live in a small town completely off these dividends. You have a second income that never requires you to work. Level 5. The exit stage. At $1.5 million, you generate over $50,000 a year. You are living a comfortable life without ever touching your principal. You have won the game. Here is the secret the pros do not tell you. Dividends do not stay the same. If you buy a dividend aristocrat, a company that has increased its payout for over 25 years, your yield on cost skyrockets. If you reinvest those dividends, you start the snowball effect. Most people quit early because they do not see the explosive growth yet. But the magic happens at year 10, 15, and 20. Compound interest is a slow burn. You have to be patient enough to let the machine build itself. Building a dividend machine requires sacrifice today to secure your tomorrow. It means choosing assets over toys. It means choosing compound interest over instant gratification. Most people spend money they do not have, to buy things they do not need, to impress people they do not like. Do not be that person. Be the person who buys income-generating assets. Be the person who buys their freedom, one share at a time. Now, you might be thinking, this all sounds great, but what happens if the market crashes? This is the question that haunts every new investor. But this exact moment is what separates an amateur from a professional. When the market crashes, most people panic. They see their portfolio turn red, fear takes over, and they sell their assets at the bottom. But for a dividend investor, a market crash is not a tragedy, it is a discount sale. Think about it. If you love a high-quality company and it usually trades at $100, and suddenly it drops to $70, do you run away in fear? Absolutely not. You buy more. In dividend investing, when the price of a stock falls, its dividend yield mathematically increases. This is a double win for you. You are buying high-quality shares at a discount, and your future dividend payments are effectively getting a raise. Furthermore, you need to understand tax efficiency. When you earn a salary, the government takes a heavy cut. But when you earn qualified dividends, your tax burden is often significantly lower. This is a massive tax advantage that accelerates your path to wealth. Rich people aren't just rich because they earn more, they are rich because they understand how to keep more of what they earn. There is one major trap you must avoid: yield traps. New investors are often lured by companies promising massive dividends, sometimes 10 or 15%. Beware. If a company is paying an unsustainably high dividend, it usually means the business is failing or the stock price is crashing to compensate for a dying model. Always choose companies with a history of consistency. A company that has paid and raised its dividend for 25 years is 1,000 times safer than a get-rich-quick, high-yield stock. Consistency beats intensity every single time. Ultimately, your goal is not just to hoard money. Your goal is to build a wealth machine. A machine that operates independently of your physical labor. When your passive dividend income exceeds your monthly expenses, you achieve true financial independence. At that point, you don't have to go to work. You don't have to listen to a boss. You have the ultimate luxury, the power to choose how you spend your time. This freedom is worth more than any sports car or designer watch. The road to this freedom will have ups and downs. Markets will fluctuate. But when your focus is on dividends, your target isn't the daily price, it is the consistent cash flow. When you focus on cash flow, the daily noise of the market becomes irrelevant. You stop watching the charts with anxiety and start watching your automated deposits with pride. You are no longer just a participant in the economy, you are an owner of the companies that drive it. This is how you shift from being a cog in the machine to the architect of your own destiny. The math is simple. The discipline is hard, but you are capable of both. If you found value in this breakdown, hit that subscribe button. It helps the channel grow. Drop a comment below. What is the first bill you would cover with your dividend income if you started today? I will be reading them all.